All right, it looks like Twitter is going to lay off another 200 workers. In case you're counting, that's going to bring the head count there to just under 2,000. I believe when Elon Musk formally took over the social media concern, it had about 7,500 workers. So what to make of what's going on there and a read of technology and the markets in general? Lou Bassett with us, the Public Ventures President and Chief Market Strategist. Lou, good to see you again. What do you make of this news?
I mean, if we ever needed a better example about tech's overexpansion, I mean, Twitter has cut over 70% of their workforce since Elon Musk has taken over. So, and it's still functioning just fine. So it makes you wonder, what were all those employees needed for? And as you look across the tech space, I mean, Amazon hired over 600,000 employees during the pandemic. You had Google and Amazon and Microsoft just on a hiring spree. So Elon Musk, I mean, counterbalance. He's coming in like the old Jack Welch, you know, hire slowly, fire fast, and fire a lot. I think it's what he needs to do to turn Twitter around. So, I wish the stock was publicly traded again at a much cheaper valuation. These things would be applauded in the public markets. Yeah,
could you imagine? I was thinking the same thing. You know, another thing, though, you look at these percentages, you said 70% from those highs have been laid off. And we have seen layoffs in the tech sector. In fact, they've been rampant, but they've been relatively percentage-wise small. Can you imagine if they got anything approaching that magnitude? Does that indicate that other tech companies are going to look at each other and say, you know, some of our layoffs have been relatively tame?
Yeah, I think you're hitting that nail on the head, Neil. I mean, if you look across the board, it's usually about 5 to 10% of the workforce has been laid off in tech. So for me, that's prudent management as we come into a tougher cycle for tech, higher interest rate environment. So I want to see them doing those things. Microsoft laying off 10 to 12,000 employees. You know, those are good things from a shareholder basis, not if you're the employee being laid off, but those are the prudent financial moves you want to see these companies making in this type of market here, you know.
We're looking at the markets attempting a comeback today after a sour week, one of the worst weeks we've seen for the markets, since going back to last fall. They're having a devil of a time gaining any traction here. So how do you look at things?
Look, I mean, interest rates are going to be the tail that wags this market for the inevitable future. I think the last time I was on, we were talking about the potential for the Fed to keep hiking rates. You know, some pundits were saying it's 1 or 2 more hikes. After Friday's hot inflation data, I think the odds of a 50 basis point hike at the next meeting has gotten a lot higher. I mean, it was almost non-existent if you look at the futures trading and probabilities, and now there's at least a 30% chance that could happen. So until the Fed's done hiking, I think you got to go bottom up, not top down. The big indexes are going to be really volatile. I think Pfizer really sending a message, a place to look in the market, with them reportedly in a deal to buy Seagen, which is a leading player in precision cancer therapeutics. So if I'm an individual investor, I'm looking around saying, where is the puck going next? And in the biotech market, it's going to be in those targeted therapies. So a lot of companies operating in that space, several names people can look at. Q Biopharma, a company we banked, but also very differentiated. I own, my firm owns. There's also another name, Immunome, and then Lantern Pharma. These are all companies operating that were sold off very deeply, but have precision therapeutics that are potentially worthwhile investments in a market. If you see Pfizer buying a company possibly for $30–40 billion, if we can buy those companies for $300–400 million, that's a good risk reward in this market.
So more biotech than just tech.
Yeah, because biotech, if you look, Neil, biotech sold off very steeply, way more than the rest of the market. Right. NASDAQ came in about 30%. The biotech from peak to trough was down about 65%, which was the second worst correction in the history of the biotech index. So you saw the riskier areas of the market, biotech, small caps, micro caps, get hit first. And if you look at the Russell 2000 this year, actually, it's up about 8%. It was up about 13% at one point. So the smaller end of the market is faring a lot better just because they sold off sooner. So the values got more obvious there sooner. Some of these big cap names still trading at a little bit of frothy valuation. So again, I think, like I said before, in summary, it's don't go big, go small. Look for where those players might be some undervalue in the markets.
I like the way you think, Lou. It's always very, very different. Good catching up with you, my friend.
Thanks, Neil. Appreciate it.